in 1990s to 2008, let's say, or 2003 largely, where Indian stock markets between the Harshad Mehta period and the Ketan Parekh period went literally nowhere. The Sensex moved from around 2,500 back to close to 2,500 in after the Ketan Parekh bust in 2002. So for that 12, 13, 14-year period, the stock market investor felt cheated. On the other hand, in metros, we saw real estate prices literally triple or quadruple. So that your parents' generation cannot relate to your preference for equities. And I see that in session after session after session. And I literally hold more than 100 such sessions with corporates, colleges in a year. And the same feedback I get is the earlier generation prefers real estate, the new generation prefers equity. And here is the psychological reason why that is so. So, having understood this brief background of how India has been investing so far, let's get to our purpose here, that how to go about building your personal portfolios. In general, my advice to young investors is, if your portfolio is small, go with a DIY approach. If it is large, you should have some kind of advisory help, because investing is a skill. And as you keep building on that skill, you become better and better and better. And you don't want to spend 10 years learning and then realizing, you know what, I made the wrong choices all this while. This was the path to follow. But anyways, so the first logical step is, after you begin your careers, after you are settled in your jobs and you have a steady stream of income, or from business or profession, as you may choose, is get these 6 grids very, very correct and put them down on an Excel sheet, put them down on a piece of paper, whatever you're comfortable with. And that will help you sort of be a starting block of where you stand. So what are your monthly expenses? Jot that down. Approximation. Are you currently carrying any debt in forms of home loans or EMIs or white goods or so on and so forth? How much monthly income do you have? How much do taxes eat into that income? Do you have any legacy assets from your parents or other assets that you may have before you began working? And are you insured? So for most individuals with some dependents or even no dependents, we usually suggest 2 kinds of insurance. One is a term plan, one is a mediclaim. Everything else, every other insurance product like a ULIP or a endowment plan or a money back plan is not really insurance. I'm sure you're all aware that it's not insurance. It's just an investment product being packaged as insurance, and we don't suggest that. They don't take care of any risks. There are other better investment mediums available for young people, and so on and so forth. So put all this down on an Excel sheet. Make sure this is your first building block to understanding your finances better, your personal finance better. This should be your step one. If you guys have any question related to this slide, please let's address it right away.
Sir, there is someone in the chat box has asked that
Sure.
what percentage of Indian population is indulged in stock market?
The figure is going up quite dramatically. My sense is it's close to between 10 to 14% now. It's been rising very rapidly since we saw apps like Zerodha and Upstocks spread awareness at a very vast level. My sense is that in a limited way, up 10 to 15% of people are investing, trading in the stock markets in some form or the other. Again, these are broad estimates. There is no scientific figure available here. It's a rapidly moving figure.
All right, sir. Thanks.
Okay, so should we move on?
Yes, sir.
So once you've got all that on an Excel sheet or on a piece of paper, and let's understand from a financial plan point of view, what should be your step two? And this should be your step two logically. List down all your financial goals. It could be one goal could be to buy a house, one goal could be to budget for your marriage, one goal could be a foreign trip, a car, it could be a child's education, it could be some thing that was on your list earlier. Now, let me tell you in practical experience, your earlier generation, if you talk to them about goal planning or financial planning in this goal based methodology, the parents will say, I have no goals. Why do I need to list down all my goals? I have enough money, or I think I have enough money. So there is no logical reason to list down the goals, because their goal is to, in large sections of Indian wealthy people that I come across, I see their only goal is to create an inheritance. And this is a practical observation that I'm giving you in what I have seen in real practical circumstances. So that doesn't matter. But even if that your goal is to create an inheritance, list it down. That will help you plan and pre-plan your finances in a much more structured manner. If you are, if you, like, for example, if you have some of you will go for a postgraduate degree to say an IIM or say any MBA school or any maybe a foreign school. That goal will require, if it's a foreign school, a crore of rupees, or even if it's an IIM, will require 20 lakh rupees. And if you start pre-planning it and preparing for it, you will be better placed for sure. So in my practical circumstances, 80% of people just don't do this. They don't list down their goals, they don't pre-plan. And once you've listed out your goals, goals are also a moving object. Your plans change. So it's not a static thing. It's not like once I have just jotted down all my goals, I'm done. No, review them. You may have thought that you want to do an MBA, and then you said, no, okay, I don't want to do my MBA. I want to do an MS. Or let's say I don't want to do my MS. I'm very happy in my job. So if those goals change over a period of time, make sure you review them and change your investment thesis accordingly. Assess all your obligations and investable surplus. Make sure you are completely in control of debt. Avoid debt as far as possible, but if you have it due to some circumstance, make sure you're on top of it. This is a critical thing. The best investors typically don't have any debt. Risk profiling. This is a technical way of understanding what is your risk profile. I see a lot of young people being very, very aware of all the financial products out there, and especially equities and leverage in equities and so on and so forth, and futures and option and so on and so forth. But if there is a 30-40% drawdown in your portfolio, if there is a 25% drawdown in your investments, are you really cut out to be able to handle that? I know from the earlier generation that they have a very risk averse mindset as compared to your generation. So there is a scientific way of profiling yourself, understanding what is your risk profile, what should be the suitability. See, this is very important. Again, this step is critical, because if markets face a bear market like we saw during COVID or we saw during demonetization, you need to be mentally prepared for that. We don't know what circumstances the markets will throw up tomorrow. If you are not prepared for a 15, 20, 25, 30% drawdown, you cannot be investing all your money in equities. You need to be very, very careful in this aspect. Make your investments based on your time horizons. So once you've listed down your goals, and if say you have a goal coming up in 2 or 3 years, don't put that money in equities. Again, very critical. We uh, we don't know where equity markets will be in 2 or 3 years. That money should ideally go to the debt side of your investment portfolio. And the monies that you're putting away for 5 years, 7 years, 10 years, yeah, sure, you can definitely put that in equities. Again, if your risk profile is suggests that you can do that, again, to the limits that you should be doing that. A good plan, again, as I said, is a moving plan. Your goals are moving. your circumstances are moving and your markets are moving. So at timely intervals of a month or 2 months, keep reviewing, keep understanding where you stand vis-a-vis your original plan. Moving on to the next slide, let's talk about, okay, you've done the hard work, you've saved the money, you've understood where you stand as of today, you've done your risk profiling, you've made your financial plan, you've put your goals down, you've understood your time horizons, and now comes a part to decide what investment options as Indians typically we have. Of course, we live in a global world and you can invest anywhere now, but there are limits, obviously, because of capital convertibility. Largely in the investment horizon for Indians in particular, these are some of the popular ones. You can have fixed deposits of banks or corporates, stocks or equity mutual funds, debt mutual funds. We obviously discussed our Indian obsession with real estate, gold. I forgot to mention, I think that Indian household wealth is 10% in gold. So 80% in real estate, 10% in gold. You can imagine how low our financial commitments are or into to the stock markets or the capital building side of things. Insurance, again, as I keep saying, that it's if it's not covering a risk, it's just a mask or it's being masked. And investment is not insurance. But again, a lot of people tend to treat it that way. And obviously now we have emerging classes like cryptos. So again, it's difficult to term them as an investment class, but well, a large number of people in India, almost 6 crores or 5 crores people, do have some holding in cryptos or some form of it. And then we have two emerging options, which are InvITs and REITs. InvITs are infrastructure investment trusts. REITs are real estate investment trusts. They are a hybrid product between equities and debt. And for they are ideal for investors who are very risk averse and also who don't want the volatility of equities and who don't want the absolute safety of debt and feel that the debt returns are too low. So these are some of the options that we typically have. This is just a broad table to understand how returns have played out in the 1 year, 3 year, 5 year, 10-year buckets that we see. Stock markets have obviously been a stellar performer during this entire period. And one way to analyze stock market returns is through GDP. And what are stock markets? Stock markets reflect the GDP growth plus inflation plus the premium that the top corporates enjoy in this country. So to put in very, very, very simplistic terms, if India grows at 8% and inflation is at 4%, that's 12%. And the top companies, obviously because of their brands, networks, human resources, their capabilities, their better understanding of their markets, will enjoy a premium on that. So you can expect a 14% return, let's say 2% premium to corporate GDP or to Indian GDP. So you can expect a 14% return in equities if you can ride the volatility and if India keeps growing at 7-8%. There are two major ifs there. But we have in general seen that playing out, and no other asset class has that kind of returns in India. Because debt gives returns of like a bank fixed deposit gives 5.5%, corporate fixed deposit gives about 6%, and so on and so forth. And gold, we can track from this table here, this data here, that gold has not been able to match up, or neither has real estate. We don't have it as part of this table, but I can tell you that real estate has not matched these returns in the 1, 3, 5, or 10-year bucket at all. After doing all the hard work of matching your investments to the time horizon, to your goals, you have to keep in mind taxation. As you can see from this table, equities are taxed at a much lower rate as compared to gold, real estate, or especially bank fixed deposits. And tax, when you are early in your career, you may think it's a very small part of your outgo. As you keep accumulating monies and the wealth grows over a period of time of 10 years, 20 years, 30 years, 40 years, tax will play a huge role. The compounding effect will be quite dramatic. So be very, very aware of whatever instrument you buy and what are the taxation aspect related to it. Uh, Believe me, the gain loss in making the right tax choices can be literally in lakhs, and there is no running away from tax. No matter whether you pay it today or tomorrow, you cannot endlessly defer it. So be very, very aware of how tax will impact you and your investments. So many times a lot of young investors come to me and ask me, I want to do my own investments. I believe that I have these, I follow these blogs, I read up all this on internet, and I follow these influencers and so on and so forth, and I think I can do it. And through my journey, I have seen them make some mistakes, which is common. Even if you start, let's say, learning how to play the piano for the first, say, 6 months or a year, it will take you time to understand what key goes where and what melody sounds correct and so on and so forth. So it's the same thing. It's about learning a skill, and these are some of the difficulties that I have seen DIY investors face. So if you start your journeys, please keep these in mind. One is, it is very tough for a DIY investor to choose between similar products. So let me give you an example. If you choose, say, an Axis blue chip fund vis-a-vis a SBI blue chip fund, or say a HDFC corporate bond fund vis-a-vis uh, ICICI corporate bond fund, they sound so similar that it'll be difficult for you to understand why one should be preferred over the other. The second difficulty that I keep observing is that there is a limited understanding of riskiness of product. We have seen instances like the DHFL NCD issue, and you should Google all this and read up about it if you want to build your personal portfolios. The DHFL NCD was the largest NCD. Well, what is an NCD? NCD is a non-convertible debenture. It's exactly similar to a bond. You give money to the company. The money is returned to you after 3, 5, 10 years, exactly the way, say, a fixed deposit would be. And the company pays you interest on it. You can choose the interest to be paid out right at the end, or in a way that it can be a annual or a half yearly interest payment. So DHFL NCD was one of India's largest NCD issuances ever, 20,000 crores. DHFL failed after that. Franklin Templeton Debt Fund issues, again, read up about it whenever you're free. 27,000 crores blocked for investors for close to a year and a half. We've seen many such issues in not only debt markets but also equity markets, when equity funds where certain funds have behaved in a, say, a questionable manner. For instance, we saw certain funds take on the Paytm IPO, and the stock halved immediately. So it would do well to question those fund managers as to how they justified this kind of valuation for Paytm when other fund managers or the larger universe of fund managers ignored this IPO. So moving on, if let's say you have invested over debt funds, equity funds, fixed deposits, REITs, InvITs, say you have 2, 3 insurance products, it is going to be difficult for you to track all these products and assets across different uh, products and different asset classes, without some technology background, some technology platform. Sorry, not background, but technology platform. most DIY investors have very limited understanding of tax or exit loads in general. So build that. Every time you are considering investing in a product, make sure you read up about what is the applicable tax and what is a holding period. They have limited understanding of products with lock-ins. So we saw a lot of mis-selling in ULIPs, and investors are still stuck with ULIPs 5 years, 7 years, 10 years down the line. Uh, Again, there are a lot of close-ended mutual funds also, like FMPs and other mutual funds which have lock-in periods. So be aware. And this particular point that I'm getting to right now, if you are a new investor and if let's say you've invested 5 lakh rupees in the equity markets and if suddenly you see that 5 lakh turn into say, 3 lakhs, new investors get very, very fearful and start thinking that they should just not be in these markets at all. So I've seen this happen time and again with hundreds of investors, and what happens is during the worst times, investors exit the markets and they buy during the bull markets and they sell during the bear markets because of this problem. Many investors sort of don't stick to their long-term plans and quit if they don't see results in the extreme short term. And yeah, in your careers, if you're very, very busy in an IT company, you're spending 10 hours, 12 hours coding, or you're in a pharmaceutical company and managing tons and tons of responsibilities, or so on and so on. Many careers have they just don't leave time to be able to efficiently manage your personal finances. Uh, Again, investors sometimes just don't have the knowledge of new products, like I mentioned, REITs, InvITs, and many other NCDs, and so many other products in India, and they cannot manage their portfolios efficiently because of that. So, with this, I want to quickly end my presentation and may ask you guys about your investment journeys. If you have anything that you would like to share, a lot of people from other your young investors like you all keep telling me about how they have started their investment journeys, and I'll be happy to hear about your experiences. Thanks.
Sir, I have a question.
So,
So you said that people often have problem choosing one blue chip stock over the other. So how to go about it? What's the answer to that?
my suggestion to all investors who are not particularly experienced in investing is to not go down the stocks path, but go down the mutual funds path. It's a less risky path. And what happens is there are many micro risks when you start investing in stocks. So, if for whatever micro risk, if your stock goes from 100 to 50, how will you have the conviction to hold on to it? How will you know that this company is sound enough? Anyway, I'll still take you through a quick run on how professional investors choose stocks. It starts with a very concrete analysis on the history of the promoter. The promoter is extremely important. The next thing is to understand the competitive landscape. The third thing is to read absolutely anything and everything available on the promoter and the company from the internet. The fourth thing is to have a detailed analysis of 5 to 10 years balance sheet and P&L available. And the sixth thing is to understand what is the driver of the valuations of the company. It's what are its competitive advantages? And only if you follow these steps scientifically should you be dabbling in stocks. Because if the stock price halves, you will not have the conviction to hold on. And borrowed conviction is like borrowing an emotion. You can't do that.
Right, sir. Thank you.
Right, sir. Thank you. So there's a question in the chat box.
Sure.
Is it good to invest in cryptos and NFTs as now it will be charged 30% tax? And also India is planning to create Indian crypto as well. So what do you think that as it is a good option for future or not?
My own sense is that I'm very bullish on blockchain technology as a technology and metaverse. I think these are two fantastic emerging ideas in the investing space. But when it comes to individual cryptos, I'm not so bullish because we don't know which crypto will be adopted at what rate and why. And now with 30% taxation and the FM saying immediately after taxing the asset class that I'm not legitimizing it, I'm simply taxing it. So there is too much ambiguity there. Also, time and again, we keep reading about hackers emptying wallets. We keep hearing about passwords that are missing. We keep hearing about exchange transactions that don't go through. There is no legitimization in India. There is this huge tax. We don't know anything about the riskiness of each crypto. Okay, we know that there are these stable coins. They are termed as stable coins, but they are so volatile. So my sense is that I'm averse to cryptos in particular. There are other ways to invest in blockchain and metaverse. There are ETFs available in the US, and we can, as Indians, invest in those ETFs, despite the $7 billion breach that we saw yesterday. Whoever's reading the financial news will probably know about it. But anyways, so NFTs, again, it's a collectible item. It's a hobby. It can be a hobby. It is not an investment for the layperson. If you buy an Amitabh Bachchan NFT or a Mahendra Singh Dhoni NFT, doesn't naturally mean that there will be sellability tomorrow. People who are buying these NFTs sometimes are publishers or people who are going to go out there and use that commercially. They are maybe going to make a Mahendra Singh Dhoni cartoon, or they are going to make a Mahendra Singh Dhoni animation video, or they are going to use it in some kind of product placement. They are going to, place it right next to a Pepsi bottle and try to sell that Pepsi, and that is driving the valuation. You, as a common investor, if you get stuck with some odd NFT, don't expect to be able to sell it until unless you are in the game. As if you are part of that ecosystem, then you can make money in NFTs. You cannot randomly go out there and buy and sell. You get just simply stuck with it.
Thank you, sir. I think that clears that up. Samarth has asked, can you please elaborate on commodity and security futures?
Sure, I've spent a good part of my career in commodity futures and security futures. Okay, though I haven't really worked very long on that, but I'll try. What would you like to know about commodity futures and stock futures? Tell me.
So I think you can brief us about it. That would be
Sure.
nice.
Okay. So Indian commodity markets are dominated by gold and silver. Second asset class that we have a lot of futures on are metals. 5 metals get traded actively: aluminium, lead, nickel, copper, zinc. The other asset class is agri commodity futures. So we have agri commodity futures in the sense of cotton is very widely traded. Also, things like mustard seed, soya bean. See, commodity futures develop in the way where is the strength of that particular country and what is most traded or most consumed or most produced. So we have in US, you have commodity futures related to pork bellies or orange juice. We also have cotton, we have many other things, or cattle. So there, that asset class has so many traders and so much consumption, such a huge supply chain that is required there. We will have commodity futures on things like spices. For instance, we have turmeric and dhania and jeera. Earlier, we had pepper and chili. That's because those are Indian hubs, and we have enough traders and enough requirement of hedging in that area. Again, let me share with you from your perspective rather than give you this. Commodity futures is for people who are in that value chain. They are structured like that. They are built like that. They are not an investment tool. They're sometimes marketed as investment tool. That is complete misselling. Okay, if you have a cotton factory, then you can buy and sell in cotton based on your requirements, based on your hedging requirements. Makes sense. You as an investor simply goes out and just punts on cotton. Makes absolutely no sense. So from your perspective, don't treat it as an investment tool or a trading tool or a technical tool. In fact, most commodities in India are so thinly traded, the technical should not be applied to them at all. Globally, technical analysis plays a big role in commodities. Coming to stock futures, I see a lot of people, a lot of young people get involved in stocks, buying options, selling options, buying futures, selling futures. That is not investment. That is you going out and punting based on some random theory that you read about and were influenced by. Uh, in 9 out of 10 cases, it'll end poorly. You lose money there. So, unless you're very convinced, you try to make a career out of it, become a professional trader, don't go down the path.
Thank you, sir. I completely agree with you. Uh, the next question is, for young investors, what is more preferred, new and upcoming equity or existing equity since long?
Uh, a mix of both. A mix of both. See, a lot of sectors are getting completely disrupted. For instance, we see Zomato and Swiggy disrupt the restaurants, or we might see a huge Amazon and Flipkart have disrupted retailers. So if you're invested in retailers except DMart, you've got your portfolio is wiped out. So a prudent investor would take a mix of both. Again, in the startup space, in the new space, we only have 4 or 5 options like Paytm, Nykaa, Zomato, and what have you. You'll have only a handful of stocks. So that space hasn't given us enough investment options so far in the publicly listed markets. There is a huge amount of bit I can talk about startup investing and so on and so forth. There are forums, angel clubs, VC clubs, and so on and so forth. But that, I don't think that's relevant to a young investor right now. If it's startup investing, angel club investing is more relevant for a far wealthier sort of a entity who's, like, say, is mid 40s or early 50s or something like that.
Thank you, sir. Dhruv has asked, in the beginning of the session, you mentioned that we need to become better savers and then need to invest. In the large scale, this saving would lead to paradox of thrift. How do you suggest to keep a balance and avoid the paradox?
Stop worrying about macro issues. That is my simple advice to all of you. Your being thrifty is going to be good for you. Is it good for the economy, bad for the economy? The economy will take care of itself. Thrift is necessary. The more investment surplus you have, the more mistakes you will allow yourself to make. The more mistakes you allow yourself to make and remain in the game, the better investors you'll become. None of you, as you start your investment journeys, is not going to make mistakes. Take it from me. I have made plenty of mistakes, and with every mistake, you learn what does not work. So being thrifty is necessary if you want to become good investors. It is a sort of a hygiene issue. It is not a luxury issue.
Thank you, sir. Ayush has asked, a lot of people have started to invest in stock market from 2000 to 2020, and our generation has been more aware about the segment. So do you think in the next 20 years, the capital inflow in the market could be tremendous?
Absolutely. I'm certain about it, because see, if Indians are 80% in real estate and 10% in gold, the remaining is in, let's say, 5% in fixed deposits, and let's say assume 5% in equities. And with the stellar growth that equities have seen, and with the stellar GDP growth that India has seen, as more and more people become more and more aware, money has to come to the markets. It's like practically like a no-brainer to me.
Thank you, sir. Riansh has asked, so what are the various ways to analyze stocks and commodities apart from candlestick graphs, and which one is the most reliable one?
Okay. So, I'm sorry, who asked this question?
Riansh.
Riansh, hi. Riansh, I am not a technical person. I don't really look at things in a technical point of view of candlesticks or RSI or overbought zone or underbought zone. I'm much more of a fundamentalist. So I'm not the right person to be able to help you there.
Sir, I have a question, sir. Sir,
Sure.
last week I read about a startup who explored a new asset class that is fractional real estate. So, if you can just help us understand what is fractional real estate and how is it an alternative investment class for people out there?
Sure. So fractional real estate is nothing new. Fractional real estate has existed in UK market for almost a decade and a half. Fractional real estate simply means if there is an asset, a house, let's say, and you divide the shares of the house in 20 parts and sell 20 of y'all, one part each for a price. So the entire house cannot be sold. It will be held by the 20 of y'all until unless the 20 of y'all, through a majority system predetermined at 75% or 80%, decide to again sell the house to one particular individual or not. Typically, such arrangements are made, and that house will become a rent generating house for its entire period henceforth. So let's say you own 1/20th of that house. You can sell 1/20th of that house to somebody else who might be interested in generating that rent income. I hope you understood. So let's say you hold a asset, you own one fraction of it. Typically, most of you all are not going to agree on what to sell and when to sell it again. So that becomes that there is no use for that house. I mean, it cannot be sold easily. But what typically happens is that these are used as rent seeking or rent generating kind of devices. Again, my advice to any of y'all is that this becomes very, very illiquid as an investment because it's not publicly traded. Although it sounds sort of like a mix between equity and debt and then has a real estate component, so it's safe. It's not. It doesn't make sense. There is an option of REITs in the Indian stock markets. You can simply buy a REIT and sell REIT. And it's almost the same thing without having the illiquidity that would be associated with fractional real estate.
Okay, sir, I just want to ask one more
So there's a
thing.
company in India called Square Yards that is working on fractional real estate. If you can look that up, Square Yards, if you want to know more. A friend
Sure,
runs it, and it's a pioneer in this sector in India.
sure, sir. And sir, can you just help us understand how a mutual fund distribution platform operates and how do they make money? Mutual fund distribution platform.
So name a platform because
Uh,
different people have different business models. So name a platform, and I'll help you analyze their money making methodology.
Sir, let's say Z funds being run by Manish Kothari.
Sorry,
Z funds.
I'm not sure I know of this, but there are two popular models. I'll tell you a brief about them. If the mutual fund platform deals in regular funds only, there are two kinds of funds, regular and direct. If regular funds pay commissions to the advisor, and the direct funds don't pay any commissions to the advisor, it's a direct to AMC kind of approach by the investor. If the mutual fund platform pays only has regular funds, then we know that it makes money from the AMCs. The AMCs paid commission like a regular investment advisory firm. But if there are certain platforms which only give direct funds, okay, so if the like for instance Kuvera, I'm sure maybe some of you have heard of Kuvera. Kuvera gives direct funds, but what is Kuvera doing to make money? And although Kuvera will not reveal easily, we in the industry know that it is one, it is selling data in vast sums to enable targeted marketing. Two, it is placing the products of the AMCs that it has some understanding with, some kind of advertising note with, on top of the list and giving those 5 stars, 4 stars. So it's more like a B2B income that they generate by either selling data or like how you go to a retail store and say, okay, you know what, my shampoo should be on the front display, or my my snack should be on the front display. That is what they're doing. On their website, if you go, certain AMCs and certain insurance products will get prime place. And that is how they're making money. All these so-called direct platforms. So I mean, obviously they have businesses to run, so they cannot be running it for free, right?
Thank you, sir. I think it clears up the question, and I think most of the questions are cleared up.
I
and
want to
all
add
the-
one thing here. My own understanding. I want to add for young people. There are so many influencers out there, and on YouTube there are videos. There are people on so many other different platforms. I want to tell you all, please be very, very aware. They have their own separate agendas. Okay, they are trying to market something. They are trying to sell you something in some manner, where there is some kind of targeted marketing happening there. Be very careful about whose advice you take, and just because somebody has 2 lakh, 4 lakh, 5 lakh, 10 lakh followers, don't follow them blindly. I see that the mistake in this generation, that everybody who has a massive following on the internet, it's assumed that they know everything about everything. And some of these guys have not spent any time in the markets, and yet they give financial advice, and it just doesn't make any sense to me.
Yes, sir. Thank you, sir. I'd like to invite the head of our public relations department, Himadri Budania, to give a vote of gratitude to round off this wonderful session. Over to you, Himadri.
Good afternoon to one and all present here. It's a great privilege for me to propose the vote of thanks to all those who contributed in making this session a resounding success. I, Himadri, on behalf of Kirodimal College and entire team of Enure, first of all extend my most sincere thanks to our speaker, Mr. Amit Sahita, for making this session very much interesting and insightful for the audience. I would also like to thank our beloved staff advisor, Dr. Samir Lamba sir, for his continuous guidance and support. A hearty thank you to our amazing host for the afternoon, Sumer and Raghav. This session could not have been possible without the dedication and continuous efforts of our entire team of Enure. Finally, I thank the wonderful audience who turned up in such large numbers. Once again, I thank you all for your cordial cooperation and presence. Thank you.
Thank you, Himadri. With this, we come to the end of this session. We'd again want to express our deepest gratitude to our speaker, Mr. Amit Sahita, our convener, Dr. Samir Lama sir, and the audience. We hope this session has been an abode of knowledge and exposure for all of you. Thank you, everyone, for joining in. Now, before winding up, I would like to remind you all that we have another workshop lined up on the topic how to create a pitch deck at 4 p.m. That's all.
Also, all the participants will be provided with the certificate. So please add your email address in the sheet mentioned in the chat box.
Thank you, Himadri. Thank you, Mr. Ricky Sumer Dip Singh. I'm sorry, I hope I got your name right. And guys, if any of you want to ask me any questions or any queries on your personal portfolios, please take my coordinates from either Gautam or Himadri, and feel free to get in touch with me. I would love to help you all. And any questions related to your stocks, your portfolios, your digital currencies, or anything else. Thank you for being such a wonderful audience. I loved interacting with all of you all. Thanks. Thank you.
Thank you, sir, for your presence.